from Wealth Canada here. So I get a lot of questions about the Cash ETF and people asking, what is it? How does it work? And so I wanted to make this video just to kind of go through and talk about it a bit. So the Cash ETF is an exchange traded fund where you can invest money and then the money gets invested into Canadian high interest savings accounts. And then you get a monthly payout on the interest, basically, that investment earns. And so if you were just to go and open up a savings account at your bank, invest that money, that would just kind of be the direct way of doing it. That works totally fine. I usually recommend people do that if they're saving that money, for example, for a wedding, for a house down payment, for a big vacation they're going on. Any scenario where you need to invest that money and you need it to be guaranteed and you don't want it to fluctuate at all. And rather than it just sitting in an account and earning 0%, you can have it growing a little bit. You shouldn't expect to be making a whole bunch of money from this, but it allows your money just to basically keep up with inflation and just do something. So let's just say you're buying a house in a few years, or you're getting married in a few years, you're going on a big trip in a few years. In 2 years' time, your money can grow a little bit. If you need money in the next 3 years, usually that's when I say you should just do it in a guaranteed, investment product. Anytime you're investing money in the stock market, in the S&P 500 or anything like that, I always say you should have at least a 10-year time horizon, just because the market goes down, it goes up, it fluctuates, and so if you need that money in the near term, even in 5 years, there is a risk that your investment could be down in that short of a time horizon. And so if we just go quickly here, I'm going to jump over to TradingView and just look up the S&P 500. And if we look at 5 years, all right. So let's say, so this was COVID, big drop, you're investing your money, it's chugging along, everything's good. And then, let's say here, at this point in time, you'd say, okay, we're saving for, down payment. I'm going to put a bunch of money into the market. The problem and the risk that you encounter, I'm going to pull up my little ruler here. So, your money goes up a little bit, you're up 6%. That's fantastic. But then, as time goes on, the market fluctuates. And then let's say here, you're planning on buying your house and you need this down payment cash. You're down almost 4%, or even if it's at the worst point here, you're down 18%. So if you put in, just to do simple math, $100,000, you're down $18,000. So definitely not a position that you want to be in. Now, let's say you're not buying your house then and you keep, just sits there, and then you're buying your house now. Okay, you're up 24%. So if you put in 100,000, you're at 124,000. So that's 24,000 of free money, basically. So the stock market definitely fluctuates, but what I'm trying to illustrate here is that, you don't know if it's going to be up or down. If we zoom out, I'm just going to go over to, let's just see all, let's just go to, 2014, for example. So let's say, or let's even go back further to recessions. Let's go into, 2008. All right, so let's say you invested money here that you need for a house, then it drops. It might take a while to recover. And so this is September 2008, November, December, and then the beginning of 2009. And then your money doesn't really recover to this peak until 2013. So that's why I always say, it should be a number of years that you don't need it for. And then same thing here, it took a while to recover and then it went down again and then took another few years. So as you can see from this point in time, June of 2000 till April of 2013, so 13 years, it really just broke even. And so there was, quite a few dips and then, things went on. So that's why I say it should be a long-term horizon. All right, so let's get into it. So the Cash ETF is just one of many high interest saving options out there. What's nice about it is it's very simple. It works in a very simple way. If we just Google Cash ETF, you can pull up this web page, which is the official fund page for it. it has a little bit of information here. We'll talk about exactly what this means. But if you go down to holdings, you can see exactly where that money is being invested. So when you invest money in this cash ETF, about 50% is going into a national bank high interest savings account, 7% in a CIBC account, 40% in a Scotiabank account, and then another 3.5% in a different CIBC account. So as you can see, the money's invested at very reputable, large Canadian banks, and so it's pretty safe. The only thing is that when you open up an account in your own name and you put that money in, through the Canadian Deposit Insurance Corporation, your money's insured up to $100,000. And then Wealth Simple actually takes that even further, where if you put it in, it's up to $300,000. But when you invest money into the cash ETF, you're not investing it directly under your own name in these specific accounts. And so an important thing to know is that it is not CDIC insured, which may or may not be, a big issue for you. In my opinion, if you were investing millions of dollars, it doesn't really matter anyways, because CIDC insurance is only up to 100,000. But even if you're investing 50,000, I mean, you have to make your own personal judgment decision. But I feel so safe within the Canadian banking system that if any of these the banks are so profitable in Canada, but if for whatever reason they were struggling or there was something that hit them and they were going down, they would almost certainly get a bailout from the Canadian government. So to me, that's kind of just my own personal, logic and thinking behind it. But it is an important, technical thing just to be aware of, is that technically it's not eligible for the CDIC insurance. In my opinion, that's not a big deal, but for others, it might be. So how does this work exactly? So you invest money into the cash ETF, and then what happens? Well, every month you get a payout, and it's going to be a payout based on the interest that's been accumulated. And so I'm going to jump over here to TradingView, which is just a stock and ETF platform. And so let's go into this one. And let's look at the past year. All right. So I'm going to flip this view just to something that people might recognize a bit more. So how it works is on the first of the month, essentially, or it's actually the last day of the month, the fund resets and drops down to 50, which is the baseline $50 per unit. And then each day it goes up slightly as it accumulates interest in the account. And then on the last day of the month, they take that money, all the interest that's accumulated, they take that out and then they pay it out to you essentially as a dividend. It's not technically a dividend, it's a interest distribution. But for lack of a better term, most people refer to it as a dividend, and so we can kind of consider it that. But from tax perspective, it's not technically a dividend. But then it resets back to 50. And then it goes up, and then it accumulates its interest and it drops back down. So as you can see, there's some mild fluctuation here. It's not exactly perfect because this is a live exchange traded fund. It's not, if it's your actual bank account, you could control it down to the penny. There's millions of people buying this in a month, and so it's there's kind of a little bit of deviation from it. But as you can see, that's more or less how it works. And so when people see this and say, what the heck's going on? Why does it look like this? It's just because it's accumulating interest, paying out, and then it drops back down to $50 or $50.01 or $50.02. So if we go back to the history of it, we can see here that each month it used to rise up to $50.22. Lately, it's only accumulating up to $50.12. And the reason for that is just the dividend over time has dropped. It used to be, I believe, around at its highest 5% or at least 4.5%. Now it's 3.26%. So it's definitely dropped over the last little bit. And so people say, well, what's the best time to buy this? I always recommend to buy it on the last or first day of the month when it's at $50. So as you can see here, if we just jump over to a month view. So as you can see here, December 31st, it was dropped down to 50, and then it went up a little bit, 50.02. But basically, first and second month, it's going to be at 50. Or you can buy it in the first few days. If you buy it at $50.02 or 5 cents, probably fine. What you want to avoid, though, is as you can see here, how it used to be, $50.20, if you bought it at $50.20, you would never be able to sell it at $50.20 until that distribution, that yield goes back up to whatever percent that was. And so when you buy it at 50 or 50 and a few cents, you're just kind of ensuring that you're able to sell it in the future at at a profit, basically. Now the thing is, if you do buy it higher up, you're not really losing out anything, because how it works is you're accumulating that interest within the account, and then you get paid out on the dividend. You can't scam it and say, well, I'm going to buy it at 50 and then I'm going to sell it here and then I'm going to get the dividend, because how it works is you won't get the dividend due to the ex dividend date. And so, it's either, you could buy it on the last day or first day of the month, basically, and then sell it right at the end. That would be about equivalent to what you would have received in the interest payment. Or you could buy it the day before the last day and then just get the interest payment. But then the problem is that you'll have lost that much cents in by the fund resetting. So either way, I hope that makes sense. But either way, you're either going to get the dividend amount, or you're going to just be able to sell it at the higher amount you paid. You can't really do both. So that's why it looks like that. That's why I recommend to buy it at its lowest price. But just to be clear, if you did buy it at the higher amount, and then, let's say it doesn't ever go back to that high amount again, and then here, you want to sell it and it only went up to this much, you're not really losing anything, because you got more of the dividend than you really earned. So technically speaking, you can buy this on any day and sell it on any day, and you're going to get the same amount regardless. But just to kind of keep it simple, and at least mentally, psychologically, so you don't feel like you're losing money, I would just buy it at, the beginning, just so it, you're getting it kind of at the start of the fund amount. So that's how that works. Now, in terms of the current price, so right now it's $50.07. And then if we see here that there's this distribution yield, 3.26%, if you want to figure out, well, how much am I going to get if I invest in this? It's pretty easy. So we take this amount, and you just go over to any kind of a calculator tool, and then you just divide it by 100. So because it's a percentage, you need to divide it by 100, and then you're going to get this amount. This is 3.26% in a decimal format. So you need to get that just by dividing it by 100. Then you could plug in, okay, if I was to invest $10,000 and then times it by that amount, this is how much you would receive in a payment annually. So that's another important thing. X or Global X does a good job of saying this is the annual yield. Sometimes it doesn't say, some websites don't say annual. If we look here, so this is dividend yield. This is the amount. And it's a bit higher because this is probably looking at the past 12 months. Whereas Global X is saying, hey, as of next payout, this is what the current actual yield is in an annual figure. And so that's how much you would get going forward if the yield stayed the same for the next 12 months. Then what you can do is you can wrap this in brackets and then just go divided by 12. And then that's what you'd be getting on a monthly basis. So if you put $10,000 in a cash ETF, you get $27 a month. So it doesn't really seem like a lot, and it really isn't. I mean, 3.26% isn't that great of a return, but it's keeping up with inflation, and it's just a guaranteed way for your money to just basically keep up with inflation and just do nothing, rather than it potentially falling behind those. So like, let's say you need that money in a few years, especially the house example. If you're going to buy a house in 3-4 years, you don't want to just have it sitting in an account earning nothing, because then your money's actually getting devalued each year. So if the inflation percent's around 2%, so each year things get more expensive by 2%, your money depreciates at that amount. Obviously, people say, well, hey, things are a lot more expensive than 2%. Like, we've had extraordinary inflation recently, but on a 20, 30, 40 year kind of average scale, it's about 2% per year. All right, so that's what you would get. Now, this is just looking at the percentage. Now, the other thing to consider is that dividends technically aren't really paid out as a percentage. It's paid out as a certain dollar figure based on each share that you own. And so if we go down to performance and distributions, we'll be able to see here what the distribution history is. And it's for December 31st, 13, 0.6 cents, right? So that's $1 and then 13 cents, but 13.6 technically. And so that's technically the real way to calculate it. So if we see here that a share is $50.07, so we go back here, $50.07, and then we say, okay, that's what our distribution amount is. That's per month. So what we want to do is wrap that in brackets, times it by 12 months. So this is where did this go? This is the monthly payment that you're getting. And then of course, because it's every month, times that by 12. So we times that by 12 and then divide it by the current share price. That's where we get this. So this, and again, this is the decimal format. If you were to multiply that by 100, that's where you get your 3.26, which is the distribution, the annual yield. So that's how we can kind of work backwards just to verify that. And then now going, kind of with this dollar figure, cent figure here, if you were to buy a share today, so one share, you would get 13 cents per month. And so if you were to buy 1,000 shares today, it would cost you $50,070. So you'd spend 50,000 essentially, and you get 1,000 shares. Well, then you could say, okay, so my 1,000 shares times 13.6 cents, I'm going to get 136 per month. So that's how that works. It's you're actually getting that distribution amount per share that you own. The yield is just a quick, easy way to compare it against other ETFs essentially. Because if cash was to say we pay 13.6 or 13.6 cents per share, well, that doesn't really mean that much to me, because like if shares are $5 and I'm getting 13.6 cents, that's amazing, right? Because if you were to put in, okay, if it's 13.6, let's do it this way, 0.136. And then times 12, right? Because it's a monthly, and then divide it by a $5 share price. Well, that's a 32% yield, times it by 100. So that's amazing. But it's not a $5 share price. It's more like a $50 share price. And so that's where we get our 3.26%. So the price of the payout isn't really that meaningful, but the price of the payout divided by the current trading price of the unit is how you get the yield, and then that's a universally comparable number. So I think that's really pretty much it here. Actually, one other point, somebody asked me, why is the risk rating low? Why isn't it, zero, no risk? And so it is low, kind of earlier when I talked about that it's not CDIC insured. So that would be one factor. If you were investing in a high interest savings account at your bank, I would say that virtually has no risk because it is insured by the CDIC Corporation, which is a Canadian Crown corporation that insures your money. So technically in here, you don't have that protection. So that's why they do have to apply the risk rating. The other thing too is that low is the lowest risk rating level. And so by them signifying that it's low, it's basically saying of any ETFs you can buy, this is like the lowest possible risk that you can encounter. But it is important to recognize there is still like some slight risk. Just going through a couple other things here. So, this is net asset. So how much is actually owned by the cash ETF? So $5.7 billion. So if we were to see here, so yeah, that's 2 million. So 5 billion. And so that's how many Canadians have money invested in this. And so within those accounts that we were talking about earlier, there's 5.7 billion that invest in those accounts. So that's how that works. The bigger the net assets or the assets under management, the AUM, the bigger the better, because that means that much money's been invested into this and Canadians are actually putting their money into it. So if there's a fund that, only had a few thousand or even a million, I'd be a little bit skeptical of why, it's just kind of that social proof. Like, why aren't people investing in this? We can see here what it's eligible, so you can own this within certain accounts. If you own the cash ETF within a non-registered, just a regular account, you will have to pay full tax on any of the earnings that you make. So you're not paying tax on the full amount you're investing. It's just on the profits. So it's very similar to like, at your job, if you get a raise from your boss, that extra money, yeah, you have to pay tax on it. So any interest you earn, you have to pay tax. If you own this within a registered account, though, then it's tax free. And then we can also see here the management fee and the management expense ratio. The difference between these is the management fee is what percentage is Global X taking to manage this for you, right? So they're managing the different accounts and moving the money around and stuff like that. So they're taking a 0.1% fee. So just to calculate that, so if you were to invest $10,000, they are taking a $100 fee per year, but they're taking that out of the yield that you're earning. So you're not actually seeing this fee. It's if we were to look at this yield, they're taking it essentially out of that, and so you're not. I mean, they're charging it on the full balance that you invest, but you're not really seeing it because they, let's say this technically should be 3.36, but it's 3.26 because they take a sliver of that. And then management expense ratio, this is just with like account fees and currency conversion fees and brokerage commissions and stuff. So, I mean, in this account, there's no currency conversion, but that 0.01% is just accounting for miscellaneous expenses that they incur by managing it on behalf. So they're taking like their cut, their pay, and then there's a little bit in fees that they're incurring. So it's not this plus this, it's just this. So the management expense ratio is what's the total amount that you're going to pay in fees, and then how much am I actually paying to Global X specifically. So that's pretty much it then. So if you have any questions, just comment them below. And thanks very much for watching.